Welcome to Wealth Well Done. Together, we'll cover a wide range of important topics surrounding money and the impact it has on our lives. From the sophisticated and highly valuable planning techniques of the ultra-wealthy to the commonly underutilized biblical teachings. Together, we'll work to improve our relationship with money and our effectiveness in stewarding it well. Here's your host, Eric Scovill.
All right. Welcome to the 28th episode of the Wealth Well Done podcast, where we go after the tactical, practical, and spiritual advice to help you do your wealth well done. Last week, we did a solo cast where we talked a little bit about how to assess the value that your financial advisor is bringing to you. And this week, I am very excited to bring on Joe Van Voorhis. Joe is with Generational Equity, been there for, you're going on 15 years now, Joe, that you've been there?
15 years, yeah.
Okay. So Joe is going to come in here and talk heavily about mergers and acquisitions. And that's, as I'm learning a little bit more about Joe, that's one of his lines of expertise. But that's where we're going to take the show today. So as always, the general disclaimer here is this is informational, this is educational, this is not meant to be specific financial advice for you. So please consult your own financial team before acting on any of the stuff that we talk about here. So Joe, welcome. Thank you for joining us.
Thanks.
And,
Thanks for
yeah, absolutely. So want to get a little bit of background about you and just kind of establish some credibility here. Can you give the listeners a little bit of understanding of what you've been doing here the last 15 years with Generational Equity, and then maybe even a little touch on what you did prior to that?
Sure. I started my career with a company that did tax planning for the ultra rich. We did estate planning, capital gains tax planning. Pretty much the environment for that type of planning was ended when President Bush came in, and eliminated the estate tax. I shifted over to private equity. I was there for about 6.5 years. I was a buyer, buying different companies and assets. And then almost 15 years ago, I shifted over to mergers and acquisition investment banking. So I've been doing it a long time, 35 years. It's kind of been in my blood, exit planning, trying to help either clients get there or from the buy side. So the sell side, advisory, M&A advisory, and or as a specific private equity buyer.
Okay. Can you maybe let's start with a little bit of a definition, because again, you kind of got a broad range of listeners here. When we talk M&A, what does that mean?
So mergers and acquisitions. Years ago, if you ever saw the movie Pretty Woman, one of the things they talk about is this merger of these two companies, and he finds his heart and decides that's not the way to do it. There really aren't mergers anymore. It's pretty much an acquisition. The larger company acquires a smaller company. So what we do is we help clients that want to transition from their business into either another career or retirement. So we're called an M&A, mergers and acquisition advisory firm. Our job is to help them structure their company in a way to be buyer ready, so that they can get into market, and then we facilitate the transaction of selling their business to a third party.
Okay. All right. Thank you. Sometimes, so these mergers and acquisitions can get a bad rap in the media. Some deals are notoriously bad. You got AOL, Time Warner. You got there are different deals out there that make it to the media, normally not in a positive light, and often, when we're talking about those are going to be the large ones. Those are the ones that have, these are because Generational Equity, you kind of specialize in the small and mid market. Most of the time, whenever you're seeing some of the large ones, or the stuff that's in the media, that's typically large. Those are the ones that are often the bad rap they get has to do with the investors. The investors getting hurt by something that goes wrong here. But Generational Equity, you guys focus mostly on these small and mid market. Can you talk a little bit about who we're talking about there?
what you see in the press, that's Wall Street. That's Goldman Sachs and some of the big investment banking firms that you see there, or what used to be there. And a lot of times when you see the dust up that happens from that, it's because they're taking the company and they're breaking it up. The corporate raider days are of the 80s is probably the biggest example of that. We don't do public deals. We have sold a few, and we have sold some companies to public companies, but we primarily live in the middle market and the lower middle market. The middle market is defined as transactions under $250 million. The lower middle market then would be transactions under $50 million. That's our marketplace. It's Main Street. It's not Wall Street. We don't get the headlines. Nobody writes an article about the deals that we do. A little bit different in how it comes out. So if you say, my client went through and they sold the business and they had a bad experience, I'm going to tell you that's because they chose the wrong buyer. Okay. So if we're in one of two markets, we could be in a buyer's market where the buyer's in control, or we could be like we're in now, which is a seller's market, or more specifically, a leveraged seller's market where the seller is in control. We've been in this seller's market for the last 8 years, and the valuations accordingly have ticked their way up every year.
Yep. And we're gonna get to that here in a little bit, to kind of define those markets and talk a little bit about where we're at now and where we're heading. Generational equity. Give us a little background on them. And I know, the list of awards that you guys have is exhaustive. So why don't you tell us a little bit of who they are?
Yeah, it's the largest private M&A firm in America. We have 16 offices. 2 of which are in Canada. So we do North America. So the US and Canada is our marketplace. If you look at Refinitiv, which is the resource out there that tracks our industry and ranks us, they do their league tables. So it used to be Thomson Reuters. Refinitiv was spun off and then sold to the London Stock Exchange. They do the rankings for the industry, both Wall Street and then the middle market. We have been number 1 in the middle market for every year for the last 16 years. So those are transactions up to 10 million, transactions up to 25 million. We are tied for number 1, transactions up to 50 million. We are number 2 up to 100 million, and number 4 ranked up to 500 million. So a lot of transactions, and in our industry, it's not based on the value of the transaction, because if you're private, you're never going to tell anybody what the value of your transaction was.
Sure.
So in the middle market, what they do, the private sector, they're just going to count transactions, and the way we're measured are closed transactions. Okay,
very good. Okay, so credibility established. Thanks for that. Let's go after. All right, we're going to start to immerse ourselves in as a seller of a business. I'm an entrepreneur here, and I've got my business, and we do $5 million a year or $50 million a year, whatever revenue, wherever we're at there. How does one go about valuing their business?
Okay, so that's a tricky question.
Yes, it is.
So when I was a buyer, I would tell you it's easy, that it's based on a multiple of your EBITDA, earnings before interest, tax, depreciation, amortization, interest, tax, depreciation, amortization. Yep. It is not that way. That is the buyer's method. Buyers are usually in control of the transaction. So they come in and they fool you and they say, here's how we're going to go and value your business. This is the way your industry is sold. Go talk to your trade organization. They'll tell you what the average is. All right. People believe it because buyers are at this all the time and they're professional. I'm going to tell you.
They have the checks.
And they have the checks. Yeah.
Sure.
I'm going to tell you the way to really do it is to get in market, get a large number of potential buyers, and then have the market determine value. Okay. We can guess all day with valuations. We do valuations for our clients, of course, but that's not the value of the business. The value of the business is willing buyers and willing sellers in a competitive marketplace. That's where you're going to find true fair market value. The problem with doing that is people say, okay, take me to market. And I say, but you're not ready to go to market. And they say, well, what do I have to do to get ready to go to market? Well, it's going to take 6, 7, 8 months to prepare you properly to get into market. Okay. Once we get to market, and then we can go to 5, 6, 7, 800 potential buyers. Okay. That's a lot of buyers, a lot more than you can think of. But we have the resources to acquire the buyers in our processes to be able to have that number of buyers for our clients. Getting to market, then that competitive marketplace is they're going to bid that price up. Now, when I was a buyer, I never once started with my lowest number or with my highest number, excuse me. I always started with my lowest number, right? Sure. I would never increase it unless the market came back to outbid me. And that's how we want our clients to go to market. We want them to be in market competitively.
And in a little bit, we're going to come to the one buyer is no buyer. We're going to talk about some examples there. So I'm just trying to help people walk through, if this is their first time, I'm in my whatever age they're at, but if they're working on succession planning or because so many entrepreneurs, they have their business is their retirement plan. They've poured everything into this, and they might have some 401k money set aside, but for the most part, the bulk of their net worth is tied up into this one single business. And so as they get into this process, we've just defined this is not a quick thing. But do you use should someone use a multiple to put them in a range, or are those multiples that they use so far off that you should just ignore those?
They're usually a low number. So if you say, somebody told me in my industry, I saw something in the news somewhere and they referenced a multiple. I'm going to say, okay, but put that as your floor. Don't put that as the ceiling. Okay.
Yeah, that's fair. On the same note, and I know this is a difficult one here too, but talking about trying to establish value on intangible assets, that becomes so. If I'm a contractor and I have, this type, I've got this dozer and I've got all this equipment, I can assess a value to that. But the intangible assets are obviously that's the piece that takes creativity and some experience as well. So how does a buyer, let's talk about that. How does a buyer establish their view, not what they necessarily want to offer as a sale or offer as a price, but as they're internally assessing this to decide if they want to buy this company, how does a buyer assess the intangible assets?
That's a great question. So I'm going to tell you that 80% of every transaction that we do is in the intangibles. It's off balance sheet. It's not reflected in the balance sheet. It's your reputation. It's your people. It's your backlog of work. It's all the other things that and we call it goodwill. That's what the accountants will call it, but never put much of a value on it. So put my buyer hat on for a minute. If I'm looking at this business and I want them to believe that I'm going to buy their company based on the past 3 years, 36 months moving average on their profitability. I wouldn't even say the term recast. And we'll talk about that.
Yeah, we're going to talk about that here in a little bit too.
Yeah. I wouldn't tell them that. I would say your profit, because a private business doesn't do EBITDA. They do net profit. Okay. Right. But you're a private business. What do you try to do? You try to push the value down. So your financials don't truly reflect what the company really makes. Okay. So when I look at the intangibles as a buyer, I'm looking from my standpoint, moving forward, what can I do with this business to make more money than you did? Okay. Sure. So I really want to know the future. I want to know what's going to happen. So one of the things that we do in our process is we do a strategic growth plan, a 5-year look forward strategic growth plan. Some people can call it a pro forma, but I want to have that. I don't want it reflected in my offering memorandum, but I do want it to be presented later when we're negotiating the terms and conditions of the deal. And in there, I want to show them, to show a buyer, here are the things that I have that make me successful, unique in the marketplace. You as a buyer with your capital, with your time and energy, I don't have that as a seller, but you can take and leverage that and make more money. As a seller, if I can show the buyer the path forward, how do you make more money? Yeah. You have different assets than I do. So together, my knowledge, your capital, your distribution channel, your sales force, whatever it is, that's going to allow you to make more money and them to bid higher.
Thank you for that. Who are the traditional buyers here, and how sophisticated are they? And then obviously there are two different things. Because one, you have this network of thousands of buyers that you can take a business to, and who's going to go after a certain type of business, certain type of industry. But who are and so you got that list, and then you have people who are local, and you've got a aggressive 30-something, 40-something-year-old local guy who wants to take over this business too, and so you've kind of got both of those. But for the most part, who are the traditional buyers here?
Yeah, so I'm going to divide in two categories here. There are people that knock on your door. There are the competitors across town. They're your employees. And I'm going to say most of the time, those are bottom feeders, not really a buyer. So the professional buyers, so we have a database and we have an app called DealForce where buyers sign up for access to our deal flow. And we have 34,000 qualified professional buyers in this database. And to
34,000 qualified, and
34,000
that qualified is like really actually qualified.
And so what they have to do to qualify is they have to show us they have the cash to buy our clients today, because this is a cash business. There are too many buyers in the marketplace right now and not enough sellers. And I don't want to go through the process for 10 months and find out at the end that the buyer doesn't have the capital and they were going to go to a bank. But, hey, have you seen interest rates lately? Hey, Mr. Seller, will you carry the note?
Right.
No. Okay, so in the professional buyer pool, it's strategic buyers that are local, strategic buyers that are regional, national, international. So foreign buyers, foreign public buyers, family offices, EB-5 visa. I don't know if people are familiar with this at all, but it's a foreign national that would come to the U.S. and get acceleration of a green card and citizenship if they own a U.S. business above $1.9 million. So right now, that's Hong Kong. If you live in Hong Kong, 150 years of capitalism, and now all of a sudden you're going to communism, there are a lot of people that are getting their kids or their grandkids to the U.S. and they want that visa to get in here, 10,800 of them. They don't care what the price is. So I tell my clients, I go, is it okay if we bring in, a Chinese national from Hong Kong that speaks primarily Mandarin to own and run your business? And they go, oh, no, I don't want those people, that group of potential buyers. I don't think that's a good fit. And I say, I don't care. They're really good bidders. And that's what we're looking for. Is we want the pressure, right? We want market pressure to raise the price.
Sure.
So a lot of different type of buyers. We want to cast the net wide. We don't want the local competitor across town. We don't want your employees or your children to be the buyers. That represents maybe 3% of our deals. We want to get an independent third party from one of these other silos. Okay. So we want strategic, and then we want financial. So private equity, family offices, funds of funds, whatever it is. We want the other, both domestic and cross-border, we want them access to the deals.
Okay. All right. Let's go after the next piece on recasting. So we talked a little bit about this. So recasting here is, I'm a standard private business, and I don't want to pay as much as possible in taxes. I'd prefer to pay as little as possible. So therefore, I do the legal above the board stuff, and we're just going to assume that all entrepreneurs only do legal above the board stuff. Right. But I'm doing that, and I am just driving down my net profit that I show that I wind up paying taxes on my adjusted gross income at the end of the year. So now describe to me what recasting is.
So as you said, is the perfectly legal way, right? When we work with a client, we don't do your taxes. We're not reporting to the IRS. This is for a transaction between two parties, private parties. So they want to know that the information they're being given is accurate. So we look at what we're producing for our clients, recasting the true profitability. If I push down my value because I take a really large salary above replacement cost, I pay myself $500,000, but the person that I would hire to replace me maybe makes $150,000. I'm going to recast that $350,000. That was just your way to take the capital out. Okay, your profit. I pay myself rent. I pay myself a little bit above market rate. Okay, I'm taking money out more in rents than I'm taking them out in my salary. Okay, and then a distribution. So whatever it is that I can do, if it's I
talk about paying your children, paying or other family members. There's all sorts of other things that you maybe wouldn't do.
Right. So, for example, I sold my last business 4.5 years ago, and both of my children were at school, and both were employees for the company. And I paid them to be the webmaster and my social media director. Okay. Is it legal for me to pay them?
Absolutely.
Is there a certain amount of money that I have to limit it to? Nope. Can I overpay my kids? I mean, that's legal. I mean, there's a certain level that you can't get to.
There's a gray area. We talked about that a few episodes ago in terms of this. Like the IRS has guidelines, but you can absolutely pay someone and for what they're worth.
So my kids were on scholarship. The balance of what they had in tuition, I paid them to do a job, and that paid their tuition. Okay. Yeah. At a much lower tax level. Above the board, legal, not trying to do anything wrong or underhanded at all, paying my tax. But what we want to do, let's say that we go out and we buy a new AC unit and we put it on the roof. Okay. Now, it's a capital item, not a maintenance one. Am I going to replace that AC unit again in 20 years? No, it was one time only, non-reoccurring, special. That was my profit. I could have limped the old one along, but I decided to take my profit out of my pocket and buy that. So I would recast that back as profit, right?
Okay.
As if I were a public company, right? Yep. Every single dollar to the bottom line. That's what I want to try to present.
Okay. And so the what are the type of, like, if I'm just, let's just pick a business that you've done here recently with this, like what type of change do you see with recasting from what they've shown as an EBITDA before to EBITDA after recasting?
I would say it's about 30%, a 30% increase. It's a substantial.
Yeah.
And so when you look at this valuation, right, and we talked about buyers want to base it on this multiple. So what do they want to see? The worst document that you can provide them is your tax return. Second, is your financials, your P&L, income statement, and your balance sheet. Okay. But now I have stepped up, right? I've added these things back. So my net profit was here. I've stepped it up. I want my launch point. If there's going to be this multiple in there, I want that launch point to be bigger because it'll be times 5, 6, 7, 8, 9.
Right.
And so the way we then, and I don't want to confuse people because I'm using that term multiple here. I don't want to do a multiple for my clients until the transaction is done, because that's how our industry tracks deals. Whereas a buyer wants you to do a multiple based on the last 3 years.
Mm-hmm.
I'm selling the past rather than selling the future. You want to sell the future with that step up to a higher launching point and then get the dollars. I don't want them focused on the multiple. I want them focused on what this business can do in the next 5 years.
Okay. All right. So yesterday, this is switching gears a little bit, but yesterday I was at a family office conference, and there was incredible wealth represented there. A number of businesses were there making pitches, a lot of investment funds, and one of them was a fund in the liquor business. And they were talking about look at the returns that our funds have had here from, a fund we started in 2016, a fund we started in 2018 and 2020. And they're showing these, wonderful returns, that they have done here, currently where they're at, each of those funds, what that's been returning. Now, in the last 3 years, they have seen an incredible spike in sales due to COVID, and the liquor industry as a whole has had a massive run up. So how do buyers, so we knew, a buyer's, maybe in 2020 or 2021, they might see this and say like, well, there's still a lot of room to continue capturing this wave. Someone in 23, or, we're looking at, 24 here now. How would someone now look at an industry that has had a big, some big event like COVID and what that did to an industry? How would they look at that now and try to discount that back?
Yeah. So to me, the big one would be any kind of restaurant, right?
Okay.
Really struggled and suffered during COVID.
Mm-hmm.
When now I'm a buyer and I want to opportunistically buy. How do I do that? And how, as a seller, do I try to get a better value for that? Well, I'm going to go in, I'm going to say it was COVID dummy, because look back at COVID, that was an anomaly. That wasn't business as usual. They tried to survive, and a lot of restaurants did not survive.
Right.
Now, out of COVID, we're back to normal. So they were on a trend up and went down. Now we're back to where it was. We're saying just connect the 2 points, because that's really the reality of what COVID was. It was the anomaly, but we're not in the anomaly. So we've got to take it back and add back into what would have been normal over those times. So I'm not going to do 36 months of moving average. I'm going to do 18 months, or I'm going to do 12 months.
Okay.
And I'm going to weight that higher.
Yeah. Okay. Well, so I'm being purely selfish here, just for my own understanding of this from a buyer's perspective. When you see this, go back to this example here of the liquor company.
Mm-hmm.
What are you doing? How much value are you putting on this anomaly event versus saying, well, this is the new norm inside this industry? How do you make sure that you're not buying into a real estate deal in 2006?
So as a buyer, I got to do my due diligence. I'm going to buy into the resources, Cap IQ, pitch book. I'm going to look at what the analysts are thinking, where the industry is going. What is this big surge in sales? Is the surge going to go up? Is it temporary? My analysis has got to come in and look at a lot of this. Okay. But here's the rub. So having been in private equity, right, I raised money. Bernie Madoff went to jail, and we had financial reform. That financial reform for private equity said that you now have a hold period. You are only able to raise this money, and you have to deploy it in a certain period of time. Mm-hmm. When I was in private equity, I had to put it in 6 months or a year, or I would have had a revolt on my hands. Today, depending on how you write that document, that offering document, you get anywhere from 3 to 5 years as a window to place the money. All right. Now, here we are. Interest rates have been low since 2009, 2008, right?
Yep.
Close to zero for 13 years, right? Easy for private equity to raise that money. If you had a company that you wanted to sell in the last 8 years, you know what you did? You sold it.
Yeah.
Okay. To the point now where there's not a lot of inventory, a lot of companies that are for sale right now with too many buyers. Specifically, half of those buyers are now private equity. 20 years ago, private equity didn't do anything close to the deal flow that they do now. All right. And they have this money that's getting old. They have to put it in. So do I look at the data? Yes. Do I want to put in a good bid? Yes. But I want to win the deal. Right. When I was in private equity, I would look at 142 deals and I would win. I won it. I won one. Okay.
Okay.
So you've got to factor in what is the prospects of me placing these dollars? Because if I don't get it placed, then I got to give it back. And if I give it back to the investors, who's going to put money with me in the future? Nobody.
So let's go ahead and hit what. So I was going to save this for later, but let's go and talk about dry powder. And then we'll use this, and then we'll go to the next. We'll save the rest for next week. But let's talk about dry powder a little bit. What is that?
Yeah. So dry powder is this money that the financial side, if that is private equity or family office or a PIG called a private investment group, whatever that is, it's money that has been raised that is earmarked to buy a private business. Okay, private equity buys private businesses. Mm-hmm. Okay, so dry powder, if we look at that in the U.S., just in the marketplace, and it depends on who you read. There's a lot of information that comes out there, but I'm going to say the numbers that I'm going to quote here are kind of the average of what I'm seeing. They say that private equity has something around $2.1 trillion. And then if you look at the rest of the financial community, that probably tops it up around 3 trillion. And then if you bring in foreign investors, foreign private equity, the total out there that I'm reading right now is somewhere around $5.1 trillion. So
of dry powder, of money looking to be deployed.
That has to be invested.
So basically the idea behind this is there's a ticker on this, and you have to get this deployed within some reasonable amount of time frame before you have to give it back, and you look real bad to your investors. Yeah. And for private equity today, as capital is getting harder to come by on the capital raising front now, and again at the conference yesterday, and then we've been seeing this across the board with the capital raising that we do, bringing capital in today is a lot harder than it was even 12 months ago. And so if I'm a PE firm sitting on that capital today, I need to get that deployed. And therefore, I might go into a competitive situation to pay higher than I'd like to for some businesses. That way, hopefully, I can still turn it into a good profit. It might not be as good of a profit had I got it at a lower price, but I'm still going to be willing to deploy those funds at a higher cost today to make sure that I don't have to give that back and look bad to an investor.
Yeah. And the problem is you gotta figure out, can I go get a good deal? Can I source a deal on my own and pay less money? Or do I go through a firm like Generational to their access of deals and pay more money, but get it done faster? And so I'm going to tell you that the private equity side, especially, it's not about the dollars. It's about time. They need to get deals done or they lose that credibility.
So I'll back that yesterday. And so we have deals that we are putting out to people, and we're looking to bring in more investors into them. And at this conference here, you have some incredibly wealthy people and their family offices talking about how difficult and how expensive it is for them to do direct investments. You got people like us, we're looking for more investors, but they're saying we are begging for direct investments, and it's so expensive for them to go through, do their due diligence, and get these things deployed. So they're struggling, looking for opportunities here, but they won't do deals with people they don't trust.
Yeah.
And so that's the thing. So one of the guys came out specifically and said that I am aggressively looking to find places to put money. And then you have a conversation. He's like, well, I'm only looking to do deals with people I trust. And so that's where someone coming into generational equity and having because you guys are tough to get to work with. Just because I have a business doesn't mean you're going to work with me. You're going to, A, it needs to be of a certain size, but B, it needs to be of a certain legitimacy because you have your own name and reputation on the line. So that's where obviously you guys bring a ton of value to the equation. I'm grateful to be partnering with you and to be able to direct people to you. Thank you, Joe. We're gonna go ahead and cut this one here, and we'll continue this conversation next week. But Joe, I appreciate you taking the time here, and we will continue this conversation here for next week. Thanks everyone for listening.
Thank you again for listening to Wealth Well Done. Be sure to subscribe to the show on your favorite podcast player, and together we'll continue to improve our relationship with money and our effectiveness in stewarding it well.